You invest your first $100 hoping it will grow. A billionaire invests 100 million hoping nobody notices. You are searching for an opportunity. The billionaire is trying not to become the opportunity. Both of you are called investors. Both may own stocks, funds, property, or pieces of businesses. But you are not playing the same game. At every level of wealth, the purpose of investing changes, the risks change, the people around you change, and eventually, even the meaning of money changes. At the beginning, your portfolio may contain less than $1,000. Financially, it is almost powerless. A strong year in the market might earn less than you spend on a phone. A bad week might erase several months of gains. Yet emotionally, this may be the most intense stage of your entire investing life. That first $5 loss does not feel like $5. It feels like a mistake. It feels like proof that you entered at the wrong time, chose the wrong asset, or were never meant to understand markets. Every price movement feels personal because the money came from real sacrifice. It represents hours worked, meals skipped, or something you decided not to buy. But your first portfolio is not really designed to make you rich. It is designed to expose you to yourself. You discover whether you panic when prices fall, whether you chase whatever has recently gone up, whether you can hold something boring, and whether you understand the difference between a falling price and a broken investment. The return that matters most is not the money. It is the cost of learning these lessons while your mistakes are still small. More importantly, something changes in the way you see money. Until now, money was mainly something you earned, stored, or spent. Once you invest it, money becomes ownership. A small amount can now represent a piece of a company, a loan to a government, part of a building, or a claim on future cash flow. You may still be far from wealthy, but you have crossed an invisible line. Your money has begun working in places where you are not physically present. Then your portfolio grows beyond $1,000 and a new frustration appears. You understand the basic rules. You contribute regularly. You may even choose sensible investments. But the results still feel disappointingly small. This is where many investors begin searching for a better asset when what they really need is more capital. Imagine earning an exceptional return on $2,000. The percentage may look impressive, but the actual profit can still be smaller than one disciplined month of saving. At this level, your income and contribution rate usually matter more than your ability to discover the next great investment. But that truth is emotionally unsatisfying. Saving feels slow. A secret strategy feels exciting. So the habit-building investor becomes vulnerable to stories. A stock that doubled, a coin that exploded, a trader who claims to earn in a week what most people earn in a year. The investor starts believing that a normal return is a personal failure, even though the portfolio is still too small for normal returns to look dramatic. The real danger is not simply losing money. It is destroying the habit before the habit has time to create scale. The first $10,000 is often built less by brilliance than by repetition. Depositing money when the market is exciting, depositing when it is boring, depositing when prices are falling and every headline makes patience feel foolish. At this stage, consistency is not a basic beginner lesson. It is the main engine. Eventually, though, the portfolio reaches a size where the market begins contributing alongside you. At $10,000, $20,000, or $50,000, an ordinary market movement can change your balance by an amount that once required weeks of work to save. This is when compounding stops feeling like a concept and begins feeling like an outside force. It is also when investing becomes more psychologically difficult. A 10% decline on $1,000 is uncomfortable. The same decline on $50,000 can feel like a personal emergency, even though the percentage is identical. The mathematics did not change. Your relationship with the number did. For the first time, the portfolio can lose more in a month than you can replace through income. The investor who spent years asking, "How can I make this grow faster?" suddenly starts asking, "What if I lose what I have already built?" That question changes behavior. Diversification becomes more than a word. Asset allocation begins to matter. Taxes, retirement accounts, liquidity, and the difference between risk tolerance and risk capacity become real decisions. You start understanding that the best investment is not always the one with the highest possible return. It may be the one you can actually hold through a bad year without destroying the plan. This is also where many investors discover a painful contradiction. The portfolio finally becomes large enough for compounding to matter at exactly the same moment. Volatility becomes large enough to frighten them out of the market. The next level begins somewhere between $100,000 and the edge of $1 million. Here, investing starts changing from pure accumulation into life design. The portfolio is no longer just a score. It may represent the ability to survive a job loss, leave a bad workplace, help a parent, buy time, move cities, start a business, or retire earlier. The money has begun purchasing options before it purchases luxury. Yet investors at this level often feel less wealthy than outsiders expect. A large account can still look fragile when compared with a mortgage, healthcare, children, inflation, and decades of future expenses. Wealth on a screen is not the same as freedom in daily life. The closer you get to financial independence, the more serious losses can feel. When you had little, taking risks seemed necessary because there was not much to protect. Now, one severe mistake could erase years of progress. So your question changes again. It is no longer only, how much can I make? It becomes, how much can I lose without changing the life I have built? This is the stage where risk can become strangely confusing. Financially, you may be more capable of absorbing a loss than ever before. Psychologically, you may be less willing to accept one because the money now protects something real. Cross $1 million, and the investment world begins opening doors that were previously invisible. Private funds appear. Real estate partnerships arrive through personal networks. Banks offer specialized services. Advisors introduce tax strategies, insurance structures, estate planning, private credit, venture investments, and products with impressive names and complicated documents. It can feel like you have entered the professional version of investing, but access is not the same as advantage. At this level, your wealth does not only create opportunities, it makes you valuable to the people selling them. Fund managers want your capital. Advisors want ongoing fees. Banks want your deposits and borrowing business. Deal sponsors want you to fill an allocation. Every conversation may sound like advice, but it also exists inside a business model. This creates one of the most dangerous illusions in investing: the belief that an opportunity must be better because ordinary people cannot access it. Private investments can offer genuine benefits, but they can also hide high fees, long lockups, weak transparency, optimistic valuations, and conflicts that are difficult to see until something goes wrong. A public stock shows you its price every day. A private fund may appear calm, partly because nobody is required to tell you what it could be sold for today. The wealthy investor may therefore lose money in a very different way, not through an obvious fraud, but through a respectable, exclusive, highly complex investment that was never suitable in the first place. At several $1 million, investing becomes less about discovering opportunities and more about filtering them. The problem is no longer that nobody will take your call. The problem is that too many people will. Then, somewhere beyond $10 million, capital becomes large enough to negotiate. You may receive lower fees. You may invest directly beside institutions instead of buying their standard products. You may finance a business, purchase part of a company, negotiate lending terms, or gain access to founders and managers without going through a public market. Money is no longer only buying assets. It is buying position. But this creates complexity at a speed most investors underestimate. Wealth spreads into companies, property, partnerships, trusts, private funds, debt agreements, and legal entities. Each piece may make sense alone. Together, they can become a system no single person fully understands. At lower levels, you worried about choosing the wrong stock. Now you worry about choosing the wrong people. You must delegate to accountants, lawyers, advisors, analysts, managers, and partners. Each person may be intelligent and trustworthy, yet still operate under incentives that differ from yours. An advisor may prefer a product that is profitable for the firm. A manager may avoid admitting a mistake. A partner may take risks because your capital absorbs part of the downside. The central skill shifts from analysis to judgment. Can you identify competence? Can you detect hidden incentives? Can you build systems that remain reliable when you are not watching? Beyond $100 million, investing stops looking like an individual activity. It begins looking like an institution. A family office may employ people to manage investments, taxes, legal structures, accounting, property, philanthropy, security, and succession. What began as a portfolio has become an organization, and now the money creates responsibilities that have almost nothing to do with selecting investments. Who controls the wealth after the founder dies? Should children receive equal authority even if their abilities are different? Should the original business be sold, protected, or divided? How much can family members spend? Which risks are acceptable? What values is the capital supposed to preserve? The greatest threat may no longer be a market crash. It may be fragmentation. One generation creates the wealth under pressure, sacrifice, and a shared mission. The next inherits assets without inheriting the same experience. Different family members develop different goals. One wants growth. Another wants safety. Another wants influence. Another simply wants freedom from the entire structure. The wealth that was built to create independence now requires meetings, governance, reporting systems, employees, legal documents, and rules. The owner has more freedom than almost anyone, yet preserving that freedom has created an institution they cannot casually walk away from. Then comes the level hinted at from the beginning, the point where more capital starts creating less flexibility. At $1 billion, many excellent investments are simply too small to matter. A business opportunity that could double $10 million may be life-changing for a smaller investor, but almost irrelevant to someone managing billions. To move the total portfolio, the investor needs enormous opportunities, and enormous opportunities are rare. Buying also becomes harder. If a giant investor tries to build a large position quickly, the buying itself can push the price higher. Selling can push the price lower. Competitors notice. Markets react. Journalists report. Regulators ask questions. Company managers change their behavior. The billionaire cannot always act quietly. This is why a giant investor may accept a lower expected return than a smaller investor. Liquidity, stability, privacy, control, and the ability to deploy huge amounts can be more valuable than an exciting percentage. Small investors suffer because many doors are closed. Large investors suffer because many doors are too small. That is the hidden cost of scale. A strategy can be brilliant with $1 million and impossible with $1 billion. The investor has more resources than ever, yet fewer places where those resources can move without changing the environment around them. At $10 billion and beyond, the word investor begins to feel incomplete. Capital at this level does not merely choose among futures, it can help create them. A decision to fund a technology can determine whether it reaches millions of people. A decision to acquire a company can reshape an industry. A decision to finance infrastructure can change a region. A decision to withhold capital can quietly end a business that looked promising but could not survive without continued funding. The investor is no longer only asking what the world will become. Their capital participates in deciding, and that creates the final transformation. At the beginning, you invest because you want more money. Then you invest because you want security. Later, you invest because you want freedom, control, access, or preservation. But once personal spending becomes irrelevant, the question becomes harder. What is the money for? More growth may increase the number, but it may not meaningfully change the owner's life. At this point, investment decisions become decisions about legacy, influence, power, and responsibility. The investor must decide which companies deserve to grow, which risks society should take, which causes should receive support, and what should happen to the capital after they are gone. So the difference between investor levels is not simply the balance inside the account. It is the question that balance is being asked to answer. At the lowest level, the question is, can this money grow? Then it becomes, can this money protect my life? Later, can I control what this money has created? And finally, what should this money influence after I no longer need more of it? Every investor begins by trying to make money work for them, but at the highest level, the real test is deciding who that money will work for next. Subscribe for more videos like this.